$50,000. Gone. Not stolen, not scammed. I lost it myself, one trade at a time, thinking I knew what I was doing. And the worst part? It wasn't even complicated. The one rule that could have saved me that money, that could have saved me years of pain and frustration, was so simple that when I finally learned it, I wanted to punch myself in the face. But here's the thing. Losing that 50 grand taught me more about trading than any course, any book, any guru ever could. And by the end of this video, you're going to know exactly what that role is. More importantly, you're going to understand why you're probably breaking it right now. Let me take you back to where this all started. I'd been trading for about 2 years. I wasn't a complete beginner anymore. I understood charts, I could spot patterns, I knew my way around a trading platform. I'd even had some winning months. I felt like I was finally figuring this thing out. I had built my account up to around $65,000. Not life-changing money, but it was real, it was substantial. And in my mind, I'd earned it through skill, through learning, through putting in the work. I was proud of it. Then I hit a losing streak. Nothing dramatic at first, just a few losses in a row. Normal variance, right? That's what I told myself. Every trader goes through this. Just stick to the plan, the edge will play out. But here's where it started going wrong. After about 5 losses in a row, I started feeling this uncomfortable feeling in my chest. Not quite panic, but something close to it. Like I needed to do something. I needed to fix this. I needed to win. So I did what losing traders do. I started forcing trades. I took setups that were marginal at best. I convinced myself they were valid because I needed them to be valid. I needed to get back to winning. I needed to prove to myself that I still knew what I was doing. A few more losses. Now I'm down maybe $3,000 from my peak. In the grand scheme of things, that's not catastrophic. That's just normal drawdown. But it didn't feel normal. It felt like I was losing control. And that's when I made the decision that would eventually cost me everything. I decided to increase my position size. Not by a lot, just a little. My logic was simple. If I'm going to win anyway, and I was convinced I was going to win because I was due for a win, why not win bigger? Why not make back what I lost faster? Do you see what was happening? I wasn't trading my system anymore. I wasn't managing risk. I was managing my emotions. I was trying to control an outcome instead of controlling my process. I took the next trade with double my normal position size. It lost. Now I'm down about 7 from my peak. And instead of stepping back, instead of recognizing that I was spiraling, I doubled down again. This one has to work, I told myself. This is a perfect setup. This is exactly what I've been waiting for. It didn't work. And this is where it gets really ugly. Because at this point, I wasn't even thinking about my system anymore. I was thinking about that number, that account balance that kept going down. And every time it went down, it felt like a personal attack, like the market was specifically coming after me. So I kept trading, bigger sizes, more trades. Revenge trading, although I wouldn't have called it that at the time. I would have called it being aggressive or capitalizing on opportunities, but really I was just bleeding out one bad decision at a time. Within 3 weeks, I'd turned a $65,000 account into a $15,000 account. $50,000. Gone. And you want to know the craziest part? The part that still makes me shake my head when I think about it? Most of those trades were actually decent setups. The strategy wasn't the problem. The market wasn't the problem. I was the problem. I sat there staring at that $15,000 balance and I felt physically sick. Not just because of the money, although that hurt, but because I knew deep down that this was my fault. I'd done this to myself, and I had no one to blame but me. So what happened next? Did I quit trading? Did I blow the rest of the account trying to win it back? No. For the first time in 3 weeks, I did something smart. I stopped trading. I closed my platform and I didn't open it again for 2 weeks. I needed space. I needed to figure out what the hell just happened to me. Because intellectually, I knew about risk management. I knew about position sizing. I knew about emotional control. But clearly, knowing wasn't enough. During those 2 weeks, I did something I should have done years earlier. I went through every single trade I'd taken during that 3-week disaster. I wrote down what I'd done, why I'd done it, what I was feeling, what I was thinking. And a pattern emerged. A painfully obvious pattern that I'd been completely blind to while it was happening. Every single trade that had destroyed my account had one thing in common. I had violated my risk rule. Not my strategy, not my entry criteria, not my technical analysis, my risk rule. See, I had a rule. 1% per trade. That was my maximum risk. 1% of my account on any single trade. When I was trading a $65,000 account, that meant I should never risk more than $650 on a trade. But during that losing streak, I'd thrown that rule out the window. I'd been risking 2%, then 3%, then 5%. On some of those final trades, I was risking almost 10% of my remaining account. And every time I lost, the next trade became even more important, even more emotional, even more desperate. I'd broken the one rule that was designed to protect me from myself, and it had cost me $50,000. Now, I know what some of you are thinking. That's it? The big rule is just risk 1%? That's basic. Everyone knows that. And you're right. It is basic. Everyone does know it. But here's the question. Are you actually following it? Because here's what I've learned from mentoring hundreds of traders over the years. Everyone knows about risk management. Everyone can tell you that you should risk a small percentage per trade. But when it comes to actual execution, when there's real money on the line, when emotions are running high, most traders throw it out the window. They risk too much when they're desperate to win back losses. They risk too much when they're overconfident after a winning streak. They risk too much when they see a setup that looks too good to miss. They risk too much because they're impatient with the slow pace of proper position sizing. The rule isn't complicated, but following it, especially when your emotions are screaming at you to do something different, that's the hard part. Let me break down why this one rule is so powerful and why violating it is so destructive. Trading is a probabilistic game. You're never going to win every trade. Even the best traders in the world lose 40, sometimes 50% of their trades. That's just the nature of the game. You're playing with probabilities, not certainties. Now, if you accept that you're going to lose a significant percentage of your trades, the logical question is, how do you make sure those losses don't destroy you? The answer is position sizing, risk management, making sure that no single trade, no single loss can significantly damage your account. When you risk 1% per trade, you can lose 10 trades in a row and you're down 10%. That's painful, sure, but it's survivable. You can come back from 10%. Your psychology is still intact. You can still think clearly. You can still execute your strategy. But when you start risking 5%, 10% per trade, the math changes dramatically. 5 losses at 10% risk each and you're down 40%, not 10%, 40%, because you're losing 10% of a progressively smaller account each time. And here's the psychological part that most people don't talk about. When you're down 40%, you're not thinking clearly anymore. You're desperate. You're scared. You're operating from your survival brain, not your rational brain. And when you're in that state, you make terrible decisions. This is what happened to me. By the time I'd lost $30,000 or $40,000, I wasn't capable of rational thought anymore. I was just reacting, trying to survive, trying to fix an unfixable situation by doing more of what had created the problem in the first place. But if I'd stuck to my 1% rule, even with all those losses, I would have been fine. I would have had normal drawdown. I would have stayed rational. I would have been able to continue executing my strategy until the edge played out and I started winning again. The 1% rule, or whatever percentage you choose based on your risk tolerance, isn't just about protecting your capital. It's about protecting your psychology. It's about making sure you can survive the inevitable losing streaks without losing your mind. Okay, so I learned this lesson the hard way. $50,000 hard. What did I do next? I took what was left of my account, that $15,000, and I made myself a promise. I would never, ever violate the risk rule again. No matter what, no matter how good the setup looked, no matter how desperate I felt, no matter convinced I was that this time was different. 1% per trade, maximum, non-negotiable. And I rebuilt. Slowly. Painfully slowly at first, because when you're properly managing risk, growth is slow. On a $15,000 account, risking 1% means you're risking $150 per trade. If you have a 2-to-1 reward to risk ratio, you're making $300 on a winner. That's not sexy. That's not exciting. You're not going to get rich quick risking 1% per trade. But you know what? I didn't blow up. I didn't spiral. I didn't have another catastrophic losing streak that wiped me out. Because even when I lost, and I lost plenty, those losses were manageable. They were just a cost of doing business. It took me about a year and a half to build that $15,000 back up to $65,000. A year and a half to get back to where I'd been before I destroyed my account. And you know what? Those 18 months were some of the best trading months of my life. Not because I was making a ton of money, I wasn't, but because I was finally trading the right way. I was finally respecting risk. I was finally treating trading like a business instead of a casino. And once I crossed that $65,000 threshold again, something interesting happened. I didn't stop. Because I wasn't violating my risk rule, I didn't have the boom and bust cycles anymore. I had steady, consistent growth. Over the next 2 years, I took that account from $65,000 to over $200,000. Not because I found some magic strategy, not because I became a genius at technical analysis, but because I followed one simple rule: never risk more than 1% on any single trade. Now, let me address some pushback I know I'm going to get on this. 1% is too conservative. I'll never make real money risking that little. Wrong. You're thinking about this backwards. Proper risk management doesn't limit your upside. It prevents your downside. And in trading, preventing catastrophic losses is more important than chasing massive gains. Let me give you some math. If you start with $10,000 and you average just 2% per month, which is absolutely achievable with proper risk management, in 5 years you'll have over $26,000. In 10 years, you'll have over $72,000. And that's with very modest conservative returns. But here's the key. That math only works if you don't blow up. If you have even one catastrophic loss, one period where you violate your risk rule and lose 40 or 50% of your account, all that compounding goes out the window. But I've seen traders risk more and make way more money. Maybe you have, but what you're not seeing is all the traders who risked more and blew up. Survivorship bias is real in trading. You hear about the guy who turned 10,000 into $1 million by taking massive risks. You don't hear about the 100 guys who turned 10,000 into 0 doing the exact same thing. What if I have a small account? 1% of $1,000 is only $10 per trade. That's nothing. Then you have two options. 1, build your account slowly and be patient. Or 2, get more capital. What you don't do is violate risk management principles just because your account is small, because if you can't trade properly with a small account, you definitely won't trade properly with a large account. The size of your account doesn't change the principles. Risk management works at every account size. Let me tell you about another trader I mentored a few years ago. Let's call him Jason. Jason came to me after blowing up 3 separate accounts. He was frustrated, defeated, ready to quit trading altogether. I asked him one question: "What's your risk per trade?" He looked at me like I was speaking another language. "It depends," he said. "If it's a really good setup, I'll risk more. If I'm trying to recover from losses, I'll risk more. It just depends." "So you don't have a rule," I said. "I mean, I try to keep it reasonable," he said. That was his problem. Reasonable is subjective. Reasonable changes based on your emotional state. When you're desperate, 5% risk seems reasonable. When you're overconfident, 10% risk seems reasonable. I told Jason the same thing I'm telling you now. Pick a number. 1%, 2%, whatever you can psychologically handle. Write it down and never violate it. Not for anything. Jason pushed back hard. He said it was too restrictive. He said he'd never make real money that way. He said he needed flexibility. I told him, you've blown up 3 accounts. What you've been doing isn't working. Try it my way for 6 months. If it doesn't work, you can go back to doing what you were doing. He agreed reluctantly, and for the first month, he hated it. He felt like he was moving in slow motion. He felt like he was missing opportunities. Every time he saw a great setup and could only risk his tiny 1% on it, he felt frustrated. But he stuck with it, and by month 3, something shifted. He stopped feeling frustrated and started feeling secure. For the first time in his trading career, he wasn't terrified of losing streaks. He knew that even if he lost 10 trades in a row, he'd only be down 10%. He could handle that. By month 6, Jason's account was up 38%, not because he'd found a new strategy, not because the market had been particularly generous, but because he'd stopped sabotaging himself. He'd stopped violating the one rule that mattered most. Last I heard from Jason, about 2 years after we'd worked together, he was trading full-time and had grown his account to over $100,000, all because he learned to respect risk. So let's get practical. How do you actually implement this rule? Step 1, decide your risk percentage. I recommend 1% for most traders. If you're more risk tolerant and have solid emotional control, maybe you can go to 2%, but I wouldn't recommend going higher than that, especially if you're still developing as a trader. Step 2, calculate your risk in dollars for every single trade before you enter. If you have a $10,000 account and you're risking 1%, that's $100 per trade, period. That's your maximum loss on that trade. Step 3, place your stop loss based on that risk amount, not based on where you think it should go technically. This is crucial. A lot of traders do it backwards. They identify where they think the stop should go based on the chart, and then they adjust their position size to fit. But sometimes that means they end up risking way more than they should. Do it the other way. Decide your maximum risk first, then place your stop loss and calculate your position size accordingly. If the technical stop loss is too far away to fit within your risk parameters, don't take the trade. Simple as that. Step 4, use a position size calculator. Don't do this math in your head. Use a calculator that automatically tells you how many lots or shares or contracts to trade based on your account size, your risk percentage, and your stop loss distance. This removes emotion and prevents mathematical errors. Step 5, never ever adjust your risk mid-trade. This is where most traders fail. They start with proper risk, but then the trade goes against them and they move their stop loss to give it more room. Or the trade is winning and they add to the position without recalculating their total risk. Once you're in a trade, your risk is locked. You can trail your stop to reduce risk as the trade moves in your favor, but you never increase it. Never. Step 6, review your risk management at the end of every week. Did you follow your rule on every trade? If not, why not? What emotional state led you to violate it? This awareness is crucial for building the discipline to stick with it long term. Now, here's something important I need to address. Following this rule is going to be psychologically difficult at times, not because it's complicated, but because your emotions are going to fight you on it. There will be times when you see a setup that looks absolutely perfect. You'll be convinced it's going to work, and you'll want to risk more. Just this once, you'll tell yourself, this one is different. This one is a sure thing. Don't do it. There are no sure things in trading. That perfect setup that you're so convinced about, it can still lose. And if you violated your risk rule to take it bigger, that loss is going to hurt way more than it should. There will be other times when you're in a losing streak and you feel desperate to win your money back. You'll want to increase your risk to recover faster. This is the most dangerous time. This is when traders blow up, when they try to dig themselves out of a hole by violating risk management. That's exactly what I did when I lost $50,000. Don't be me. The rule exists specifically for these moments. When your emotions are screaming at you to do something different, that's when the rule matters most. That's when you have to trust the process, trust the math, and stick to your risk management no matter what. Let me share one more story with you. This one is about a trader I'll call Maria. Maria was the opposite of most struggling traders. She was almost too conservative. She'd been trading for years with a tiny account, risking 0.5% per trade, barely making any progress. When I talked to her about increasing her risks to 1%, she was terrified. She said, "What if I lose? What if I blow up like everyone else?" I asked her to do the math with me. If you lose 10 trades in a row at 1% risk, what happens? "I'm down 10%, she said. "Can you survive a 10% drawdown?" I asked. She thought about it. "Yes, that's actually not that bad." "Okay, and if you lose 20 trades in a row, which is statistically very unlikely if you have any edge at all, what happens?" "I'm down about 18%, she calculated. "Can you survive that?" "Yes. I mean, it would suck, but yes." That conversation changed everything for Maria. She realized that proper risk management wasn't reckless. It was still safe. Moving from 0.5% to 1% risk wasn't going to destroy her. Even in a worst-case scenario, she'd survive. So she made the change, and over the next year, her account growth doubled. Not because she was taking on dangerous levels of risk, but because she was being properly aggressive within safe parameters. This is the balance you're looking for. Risk management isn't about being timid, it's about being smart. It's about risking enough to make meaningful progress, but not so much that you can blow up. Here's what I want you to understand. The one rule that changed everything for me, the rule that could have saved me $50,000 if I'd followed it from the beginning, isn't sexy. It's not exciting. It's not some secret strategy or hidden indicator. It's just math. Boring, simple, unglamorous math. But that math is the difference between traders who blow up and traders who compound. It's the difference between boom and bust cycles and steady, consistent growth. It's the difference between gambling and actual trading. Every successful trader I know, every person who's made it in this business long-term, follows some version of this rule. They might risk 1% or 2% or some even less, but they all have a number, they all stick to it, and they never violate it. Because they understand something that took me $50,000 to learn. In trading, survival is more important than any individual trade. Capital preservation is more important than capital growth. If you protect your downside, the upside takes care of itself. So where are you right now? Are you following a strict risk management rule, or are you winging it, adjusting your risk based on how confident you feel, how desperate you are, how good the setup looks? Because if you're in that second category, I need you to understand something. You're not trading, you're gambling, and the house always wins eventually. You might get lucky for a while, you might have a great run where your loose risk management doesn't hurt you, but eventually, inevitably, you're going to hit a rough patch. And when you do, if you don't have a solid risk management rule protecting you, you're going to blow up. Maybe not as spectacularly as I did, maybe not $50,000, but you're going to lose more than you should, and it's going to hurt. The good news is you can change this right now, today, this moment. You don't need a new strategy, you don't need a new indicator, you don't need to spend money on another course. You just need to decide on your risk percentage, write it down, and commit to never violating it. That's it. That's the rule that could save you thousands, tens of thousands, maybe hundreds of thousands of dollars over your trading career. It saved me. After I learned it the hard way, after I lost that 50 grand, I never violated it again. And in the years since, I've made back that money and then some. Not because I'm a genius, not because I have some secret edge, but because I respect risk. I protect my capital, I make sure that no single trade, no single loss, no single bad decision can destroy me. And because I've survived, I've been able to compound my returns over time. That's what this rule gives you, survival. And in trading, Survival is everything. Look, I'm not going to lie to you. Following this rule isn't going to make you rich overnight. It's not going to turn $1,000 into $1 million in 6 months. If that's what you're looking for, you're going to be disappointed. But if what you are looking for is a sustainable, long-term trading career, if you want to still be trading in 5 years, 10 years, 20 years, then this rule is non-negotiable. Because the traders who make it, the ones who actually succeed in this business, they're not the ones taking massive risks and hoping for massive rewards. They're the ones taking small, calculated risks consistently over time, letting probability and compounding do the work. They're boring, they're patient, they're disciplined, and they're profitable. That's the trader I want you to become. Not the gambler chasing the big score, not the emotional trader revenge trading after losses, but the professional who understands that in trading, as in life, slow and steady wins the race. So here's my challenge to you. For the next 30 days, follow the 1% rule, or whatever percentage you choose, on every single trade. No exceptions, no excuses, no just this once. Calculate your risk before you enter, place your stop based on that risk, and never ever adjust it to avoid a loss. At the end of 30 days, review your results. I guarantee you'll see a difference. Not necessarily in your profit, though you might be surprised there too, but in your psychology. You'll feel more in control, less stressed, more confident. Because you'll know that even in the worst case scenario, even if everything goes wrong, you're going to be okay. You're not going to blow up. You're going to survive. And survival, as I learned the hard way, is the name of the game. That $50,000 I lost, I don't regret it. I mean, I wish I hadn't lost it, obviously, but I don't regret it because it taught me the most important lesson I've ever learned in trading. It taught me that the strategy doesn't matter if the risk management is broken. It taught me that survival comes before profit. It taught me that one simple rule, followed consistently, is more powerful than any complex system. And now you know that rule too. You didn't have to lose $50,000 to learn it. You just had to watch this video. So don't make my mistake. Don't learn this lesson the hard way. Take what I've given you and apply it. Today, right now. Decide your risk percentage. Write it down, commit to it, and never violate it. That's the rule. That's the one thing that changed everything for me. And if you follow it, I promise you, it'll change everything for you too. If this video helped you, if you finally understand why risk management matters and what you need to do differently, do me a favor. Hit that like button. It helps other traders who need to hear this message find this video. And if you're not subscribed yet, subscribe now. I put out content like this every week. Real trading psychology, real lessons from real experience, no BS. Just what works and what doesn't. Drop a comment below and tell me honestly, what's your risk per trade right now? Are you following a rule or are you winging it? No judgment, just awareness, because awareness is the first step to change. Thanks for watching. I'll see you in the next one. Now go implement that risk rule and protect your capital like your trading life depends on it, because it does.